Hello, Ohio, and welcome to Retire Well with Kevin Bucher. He's one of the co-founders of Citizen Advisory Group. I'm your host, Spike Spangle. Every single week, Kevin likes to provide retirement planning solutions for our fellow Ohioans. Kevin, what's on your mind this week?
Well, gratitude. So it's a real blessing to be able to do what we do at Citizen Advisory Group and come alongside our clients and help them along this retirement journey. So just a lot of gratitude for the opportunity that comes along with that.
Right. And there's a lot of teaching that you do. In fact, I found this to be fascinating. What was your actual degree in when you're growing up as a youngster?
Yeah, so I have a bachelor's of education in mathematics. So I started my working life in education and teaching in the classroom. And so I've gone from teaching in the classroom, having to worry about what was happening behind me when I was writing on the board, to now I still write on the board and do some teaching, but I don't have to worry so much about what's happening behind me.
Well, now people are watching your financial education show, and we're trying to keep them from scrolling down too much on their phones and paying attention to what you've got to say. This is another fascinating program. We want to continue to talk about retirement risks because they're the kinds of things you see every single day in the offices, you, your brother, your entire team of financial advisors. But Professor Bucher, if you wouldn't mind, can you please explain sequence of returns? How is this a risk, and can we make it simple enough for someone like me to understand?
Yeah, so this is really going to put my teaching skills to the test, and I'm going to need a little bit of a runway to kind of go through sequence of returns risk. But in general terms, it's not just about what your average returns are. And I know that a lot of people like to focus on how much they've averaged over the last 5 years or the last 10 years. And advisors are very guilty of doing that as well, where they like to talk about this investment has averaged this much. But when we get into the retirement years or get closer to the retirement years, it's not really that much about the average anymore. It's about the order, and that is what sequence of returns is all about.
Okay, all right. So I'm getting that, and you can do that on any sort of survey. If you're taking a look at investments, if you do point-to-point returns, well, you can choose those points wherever you want to. If you choose the returns of something from 2009, when the market was at its low after the credit and housing crisis, to where it was end of a year and a half ago, the gains would look astronomical. Yes. But if you took it from before 2008, you can choose those at different times. So you're saying it's not the average return of 5 years or 10 years or 20 years. It's when you start taking from those funds.
Yes, that order is so important. And we have a graphic that we're going to use to maybe help try to explain this. So if we could pull that graphic up now. Basically, I tried to create side-by-side scenarios of the pre-retirement years, which we call the accumulation, and then the post-retirement or distribution years. And my intent isn't going to be to go through each and every line item of this, but to try to keep it as simple as possible. We're looking at, okay, in the pre-retirement years, you're saving money. So you started with nothing, you started saving $25,000 a year, that's what we're calling the deposit, and you either made 10% or you lost 10% in the investment for the 10-year period. You did that for 10 years, $25,000, you made 10% or you lost 10%. And in the first scenario, in the pre-retirement, we're saying that you got off to a good start. You made 10% each and every year for the first 5, and then you lost 10% each year for the last 5. Comparing that to if you just flip that order around, it's the same 10% positive or 10% negative, but the order was different, and what you see is the outcome is very different as far as what you have in your account towards the end. And the lesson there is that the losses at the end of your retirement the end of your working years have a bigger impact than the losses that you would have had at the beginning of your working years.
All right. I get the concept of what you're talking about. So as people look at those 20 to 25, almost 28% losses in both their stock and bond portfolio from last year, what do you do about it? I mean, for the people who needed to pull that income from those retirement accounts, sequence of returns risk was against them last year. Number one, can they make it up? Number two, are you able to prevent it in the future?
So it comes back to having a very well-balanced, diversified investment portfolio. And when I say diversified investment portfolio, I'm talking about going beyond the conventional portfolio of 60% stocks and 40% bonds. I'm talking about including some alternative investment classes to that mix, so you do truly have some diversification. That's going to be mixing in some principal protected accounts like CDs or fixed rate annuities, along with your stock and bond portfolio, mixing in maybe some gold and silver, mixing in some other alternative investments. So you do have true diversification to protect against those down parts. But it's really important that as you get closer to retirement, that you start to take the necessary steps to protect yourself, because the risk of loss at the end of your work life and the beginning of your retirement life has the biggest impact to your financial success for the rest of the way. So in that window of 5 to 10 years is when you need to take as much of the risk off the table as you possibly can.
Okay, but we still need to be aware of things like inflation, taxes, and let's be honest, sometimes the costs of the investments themselves. There's a lot of folks who think that if they leave their money in their 401ks from their former, that there's no costs inside there. There are management costs and the investment costs. So is there a magic number? Like, what number are we trying to achieve in those? Are we looking for 5, 6, 7%? Well, we've got 2 or 3 percent in cost. I mean, these are hard numbers for us to figure out if we've never gone into retirement before.
Well, I think it's a key question that those that are about to retire need to ask themselves, and that is, number one, how much risk are you comfortable with taking? But number two, how much return do you actually need to achieve for your plan to be successful? And so that's something we help our clients with is, so there is no right or wrong answer to that question, that it's not 5, 6, or 7. It's very specific to the individual investor as to how comfortable are they with the risk of the markets, but what type of a return do they need for their plan to work? And that then dictates how you should set up your investment portfolio.
And this you can do with the Retirement Checkpoint Review. This will include taking a look at their investments, the risk of where they're at right now, and all of that is part of just calling that phone number right here?
Yeah, so we're offering for the callers from today's show a complimentary Retirement Checkpoint Review. As part of that review process, we'll walk you through the vast areas of retirement planning and get you on the right path so that you can retire well. So call 866-630-1675 to schedule your no-cost, no-obligation Retirement Checkpoint Review. We look forward to hearing from you today.
Kevin, we're going to continue to talk about risks in retirement when we get back. This was sequence of returns risk. I know it might sound like a lot, but you don't have to try to figure this stuff out all by yourself. You can speak with a financial advisory firm like Citizen Advisory Group right here in Ohio. There's no cost to it. The only effort is you dialing that phone number. 866-630-1675. More with Kevin Bucher right after this.
Whether it's time with your grandkids, travel, or finally doing what you've always wanted, retirement is about having the time to live life on your schedule. At Citizen Advisory Group, we build comprehensive retirement plans customized to your individual goals. Whether you're still preparing, taking your first steps, or have been on the path for years, our trusted and caring professionals are here to help you manage the risks and navigate the challenges on the road to your financial future. Citizen Advisory Group, your retirement journey begins here.
Welcome back to Retire Well with Kevin Bucher of Citizen Advisory Group right here in Ohio. I am your host, Spike Spangle, and we talk about retirement planning strategies and solutions every single week on the program. We just covered sequence of returns risk, and that one is quite in depth. But thank you very much, Professor Bucher, as your former lifetime, but now you're a financial advisor. Let's go more into the political arena. No, folks, please don't change your channel. We're not going to talk heavy politics like that. But I want to talk about when politics change the investment world, such as legislative and policy risk. It's kind of unfair. It's like rules change to our taxes and our investments sometimes when we're in the middle of the game. How do we adapt to that?
Yeah, and it's not always legislative law changes. Sometimes it could just be policy changes, like we saw play out with the Federal Reserve with the raising and changing interest rate environment. And that really wreaked havoc on both the stock and bond markets. And that would be an example of policy risk that is really outside of your control. but it's a real risk that's out there. So that's an example of policy change risk. But then there's also the legislative risk that's more associated to our programs like Social Security and Medicare. And what's the future of these programs?
Right. Well, the future of these programs seems like they always get to be more expensive. What about would you consider legislative risk taxes in the tax code? Because I mean, that's part of changing legislation at times.
Yes. So yeah, absolutely. Tax law is part of that legislative risk. And it's interesting, in doing this for about 16 or 17 years now, I don't think I've ever met with anyone that ever thought that taxes were going to be lower in the future, right? Everyone that has this expectation that taxes are going to go up. Well, guess what? Taxes are going to go up. The Tax Cuts and Jobs Act of 2017, which was a tax cut for many retirees, is set to expire. That wasn't permanent tax law. So even if there's not new law, in 2026, we're going to revert back to the old tax system where we lose the 12% tax bracket, we lose the 22 and 24% tax brackets, and those go to 15 and 25. So even if there's not new laws, there's likely going to be tax increases.
Let's talk about, once again, the likelihood of this. You're talking about Congress and DC coming together on a resolution to keep taxes where they are. They can't even come together on daylight savings time, and it seems like the whole country wants to get rid of daylight savings time. They can't come together on that. You think they're going to change tax law in our favor in 2 years?
Yeah, I do believe they're probably going to change tax law, but I don't think it's necessarily going to be in the consumer's favor, right? We've seen the national debt just continue to explode. They need to generate new revenue. So taxes are probably going to be less favorable in the future than it is today. And if we know that today, we probably should be acting on that and taking the necessary steps.
And I think another belief on that is something that we just mistakenly started to believe 2 or 3 or 4 decades ago. People say, oh, well, I'm going to pay less in taxes when I get to retirement because you don't have that income. But that's not necessarily true. There are several things that get taxed in retirement. Your Social Security likely will be taxed, I mean, unless it's the only thing that you're taking in, but even then, over a certain threshold, you'll be taxed on your Social Security. You've got eventually your RMDs if you don't create a tax-free income stream. You've got everything that you're taking out from those investments. So thinking that your tax bracket is going to go down in retirement, true or false, Kevin?
Well, for some it may. And what I would say to that is that you have to have a framework that allows you to evaluate your tax liability over different stages of your life. And we're going to do a whole show on that.
Okay.
But without that framework, you really are just guessing. And too often, I would say, people have like the default tax plan where there really isn't any planning at all. It's just, okay, the year has passed, it's tax season, we're going to look back at the year that we've already done and add up the score and see how we shake out. And that really isn't tax planning at all. But taxes would be an area that we feel very strongly that we have more control over that than we think. So instead of just sitting back and passively letting taxes erode away at your ability to fund your retirement, take some steps to take control of your taxes today at these low tax rates before they go up. I know taxes might not feel low. I mean, no one likes to pay taxes, but we are in a low tax environment, and we should be taking advantage of that.
You mean nationally, we're in a low tax environment? I mean, taxes, you can go back 50, 60 years. There's some of the top tax brackets were over 90%. So the fact that we're still in the 20s, the high 30s, they're manageable right now. I know nobody likes having the taxes, but they're manageable. When you say take a couple of the steps, though, what kinds of things are you talking about?
Well, you have to take control over your capital gain situation, for example. So if you have non-qualified accounts where you're subject to paying tax on the investment gains in those accounts, well, you have to have a strategy for that. What's the strategy to realize those gains at the lowest rates possible? I think a lot of people are very unaware of what those capital gains rates are, as an example. The first rate is 0%. That's a great rate. So if you have the ability to take some of your investment gains at 0%, why aren't you doing that? We need to have a strategy for that. We also need to have some strategies, though, to take the pre-taxed money from your IRAs, 401k accounts, move that pre-tax money over into the tax-free accounts at the lowest tax rates possible. You have the ability to control your long-term tax liability far greater than what you realize, but you have to act and you have to do some of this tax planning.
But Kevin, you are a financial advisor, you are a family firm, you serve the folks here of Ohio. Not everybody out here watching the program is a CPA. How do you help them control those tax decisions?
So in full transparency, I'm not a CPA, but I'm going to look at a long-term retirement income plan and be able to run these tax estimates using the software that we have, right? So again, I'm not going to sit down and run through these numbers. We have software for this that is really high power software that'll kind of show exactly what our current tax liabilities are compared to our future tax liabilities so that we can make the right decisions along the way to reduce the tax liability that you're going to be subject to in retirement. So to answer your question, it really comes down to the horsepower of the software. And the fascinating thing that we know is most financial advisors don't even use a retirement tax planning software because it's an area that they don't want to get involved in. And we look at that as a really critical piece of retirement planning so that you can keep more of your hard-earned money in your pocket and use it on the things that are important to you.
It might not be the most exciting topic off the top of your head, but really when folks are saying, I have no control of what's going to happen next, one place where you can take control right now is in this extremely low tax rate environment. Do something about it now before those taxes sunset. When do they set?
So 2026, we'll be reverting back to the old tax laws before the Tax Cuts and Jobs Act was in place. So we have some time to do that. We have some time to start doing, and even when that law changes, we still are going to, tax planning will always be important.
Right.
I like to look at it like, if the focus is all on your investment returns and you achieved the rate of return that you were looking for, but at the same time you were overpaying in taxes, you took one step forward, but you took one step back. So we need to do this in a very comprehensive way so that your investment returns are real returns that you get to keep in your pocket, not someone else's.
Sometimes I've heard that you have to try to retrain the CPAs that you work with, because most retail folks like ourselves, we walk into a CPA office and go, I want to pay as little in taxes this year as possible. But what you're trying to say and retrain people on is, I want to pay as little as possible in taxes down the road.
Absolutely.
5 years, 10 years, 20 years down the road.
Yes. So reducing your long-term tax liability greatly enhances the probability of success for your retirement plan. And you're right, CPAs generally are looking at your taxes in the rearview mirror, and you really need to have a forward-looking tax strategy. Otherwise, it's likely that over the course of your lifetime, you're going to do the exact opposite of what you want to do, which is pay more in taxes.
But as we go out to commercial here, will you take a look at people's current tax? Like you said, you're not a CPA, but you can look at it as far as the retirement lens. Tell folks what the review is all about.
Yeah, so we're offering a complimentary retirement checkpoint review for callers from today's show, which will include a tax analysis, which will show you exactly where you're at today, but also do some projections for where you project to be in the future. And by doing so, you'll be able to be more tax efficient, put more of your hard-earned money in your pocket, and spend it on the things that are important to you. So call today, 866-631675, for your no-cost, no obligation retirement checkpoint review.
Kevin, as I said, we're going to take a very short break. Folks, I also want to point out to you, if you open up your phone, you've all been to restaurants where you've used that QR code. Open up to the camera and point it down at that black and white box down at the bottom. You can click on that. It'll take you right over to the website, and you can schedule an appointment there as well. So whichever you prefer, through phone call, using the website, use the number here if you want to get started on your own retirement checkpoint review. 866-630-1675. More with Kevin Bucher when we get back right after this.
As a good saver, you've been putting away money during your working years. Studies find that the biggest fear of retirees is running out of money. Market volatility isn't just the downward movement of stock prices, it's the size and frequency of change. The more dramatic the ups and downs, the higher the volatility. This can put savers who are newly retired or a few years away from being retired at greater risk. Today's generation of retirees is not receiving traditional pensions as our parents or grandparents did. Instead, we have retirement accounts such as 401ks or 403bs. These accounts typically expose your money to market risk. The last thing you want right before retirement is to lose a portion of the money you need for income. But how do you turn these accounts into a retirement income? Is it safe to keep all your retirement money sitting in the stock market? The last thing you want is to lose a portion of the money you need for income due to market loss. By working with a financial professional, you can learn how to turn a portion of your savings into an income stream for life and income for the life of your spouse if you're married. We all have moments in our lives when we wish we had taken action sooner. Don't let procrastination reign on your retirement parade. Act now before it's too late. Please call our office to set up your no-cost, no-obligation retirement income review today.
Welcome back to Retire Well with Kevin Bucher of Citizen Advisory Group right here in Ohio. I'm your host, Spike Spangle. We talk about retirement solutions for you, our viewers, every single week. And over the last couple of weeks, we've been talking about risks in retirement, the risks that you all go through, but I'm talking about it with Kevin because you help people untangle them every week. This one, though, surprised me when you brought this up in our pre-show meeting, longevity risk. I'm sorry, Kevin, I don't get, how can living longer be a bad thing?
Yeah, I almost hate to call it a risk, right? Because the goal should be to live long. But the reality is longevity risk is one of the more important risks that we have to have some strategies to deal with. Because the longer you live, the longer you have to support, the longer the lifespan that you have to support. So we actually call it the risk multiplier, because the longer you live, the more likely it is you'll go through a hyperinflationary period. The longer you live, the more likely it is you might have a health incident that requires some type of long-term assistance. The longer you live, the more likely it is you see the markets go through some downturns. So it multiplies all the other risk. So we really feel like we have to wipe longevity risk off the table and deal with that so that it's not a risk for our clients.
Right. I mean, if you go back, we call it today's modern retiree has a different set of challenges, because if we just even look at the last 12 to 16 months, hyperinflation, it's happening. You even think it's going to happen again some point during today's retiree. So if you're 65, what is the life expectancy when you're putting together, when you and your brother Jeff are putting together retirement plans, your team of advisors, what's a typical age that you're taking plans out to today?
Yes, so let me tell you a little family history. So I had great grandparents that both lived into their hundreds, right?
Wow.
Well,
congratulations.
Yes. So, and they lived healthy for most of those 100 years. They were active, and I think that's what we all want. And that's why I hate to call longevity a risk, right? Because I want that. I want that same retirement. So how long do we plan for? Well, we work with the client. Everybody's individual situation is a little bit different. But when you just look at the averages, the average 65-year-old female today has got a life expectancy of 86. So that's a long time. The average life expectancy for a 65-year-old male, 83. So those are averages. The problem from a planning perspective when we're talking about averages is you're probably not going to be the average, and we need to plan for a longer life. And I think that's something that I've learned over my 17 years of doing this, is that a lot of times people really underestimate their longevity. And the reality is the job market isn't real strong for 85-year-olds that have run out of money, right?
I'm laughing because I agree with you, but yeah, it's difficult. We definitely don't want to be looking back at trying to supplement at 84, 85, 86 years old. But it's harder. I mean, come on, Kevin, you do it all the time. I don't know how to do projections on my savings 25, 30 years from now. I'm certain that you have software that helps you out, but how do you help your client, your family envision that with you? Because I want to understand what my strategy is. How do you do it? How do you put together? How do you help your folks understand it?
Yeah, so Spike, it starts by having the very critical piece or tool for your financial plan, which is a written retirement income plan. And when we build a written retirement income plan, we really break that into two distinct categories. Category one is what we would identify as your principal protected income. Protected income that has some type of a contractual guarantee of income to you for however long you live. So it matches up perfectly with your lifetime. I don't know how long that is individually, right? I don't know if you'll live to 80, 85, or 90, but contractually guaranteed income is going to last for the rest of your life. And we want to build your plan in a way that you have enough contractually guaranteed income to sustain your basic living expenses for the rest of your life. Then we can go to alternative strategies that don't have that contractual guarantee, but that's going to be things for supplemental income, discretionary spending, spending shocks. But we need to build the plan so that you have the safety and security in place so that you feel freed up to enjoy the retirement journey.
I'm going to throw a fastball high and inside at you right now. Let's see if you duck fast enough. Is it possible today to just save enough for retirement? I mean, can we just score? Because it's longer than it ever was. Retirement used to be 5, 6, 7, maybe 10 years, and you get a pension plan from the company you worked at for 30 years. It's totally different now. Can I save enough?
It's possible that you could save enough, Spike, but if that's what you were trying to do, you would really be limiting what retirement could be. So without a retirement income plan that's designed in this way, we really find one of two things that happens. Number one, people either overspend and increase the risk of running out of money in their lifetime, which is devastating and terrible. But number two is they actually underspend because they're so concerned about running out of money in their lifetime, and which is almost just as devastating because they're not taking advantage of the retirement that they could have. They worked their whole life, set aside some money for this retirement picture, but they're not taking full advantage of it because they're so afraid about running out of money. We can wipe that risk off the table with proper planning.
You've talked about so many different risks, everything from tax risk and sequence of returns risk, market risk. All of these seem to be longevity multipliers. Would I be correct there? Was I listening, Professor?
Yes.
The last couple weeks?
Yeah, inflation is a good example. If your life expectancy in retirement is 3 or 4 years, inflation doesn't really matter that much. But when you have the compounding impact of inflation year over year over year, your cost of living as a 90-year-old is going to be vastly different for the same lifestyle than it was as a 65-year-old. So that we have to have a plan for that. We have to wipe that out. We have to get rid of longevity risk.
We're wrapping up today's program. We barely have 30 seconds. Tell them about the retirement checklist.
Yeah, so for callers from today's show, we're offering a complimentary retirement checkpoint review. As part of that review, we'll take these complex areas of financial planning and create a common sense framework so that you can make informed decisions to get on the right path to retire well. Call 866-630-1675 today for your no-cost, no-obligation retirement checkpoint review.
Thank you, Kevin. We'll be back again with more Retire Well once again next week. Call the phone number. Thank you for watching.